Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Chum, Head of Investor Relations here at Focus Capital.
I am Chad Schuler, founder of Focus Capital.
We got a big one today. I think it's because this is our most commonly asked question here at Focused, and something that a lot of influencers talk about on LinkedIn and a lot of social media is IRR versus cash on cash return. Which one out of the two matters most? So, Chad, investors hear these two metrics constantly. Which one matters more?
Neither one. They're elements of the situation, Jared. Like, do you want to have mostly cash flow as your focus, or you care about cash flow not at all and only about upside? Like, it's all about your personal goals and your strategy.
Yeah. Okay. Then let's help our investors answer this question of which matters more to them. Backing up 10 steps. What does IRR stand for? What does it measure? And what does it not measure?
Yeah. Internal rate of return. Essentially, it takes time value of money into the equation. So if you get more of your return in earlier years, then it'll be higher rate of return than if you got nothing in cash flow throughout the whole duration and all the end. You'd have a higher internal rate of return by getting more cash early.
And then a cash on cash, what does that measure and what does that not measure?
Yep, that's simply the amount of cash you receive throughout the whole duration measured against your initial investment.
Yeah, we'll talk about time horizons and stuff like that, but why does timing, because you said this is the time value of money, why does timing matter so much in IRR? Like if I'm evaluating two deals, same strategy, everything like that, same type of property, but one is telling me that I get an IRR of 15% over, 5 to 7 year hold, and this other one is telling me that I'm going to get an IRR of 15% on a 10 to 15 year hold. Oh, 15% is 15%. So like, are these both the same deal?
No, because typically an IRR goes down typically over a longer period of time. Because normally you're going to have a higher IRR on a shorter hold period, which can tempt some people to dispose early or whatnot, a whole different topic, right? But if you've got a great IRR projection over a longer hold period, some might say that is a great investment. Not only because from the perspective, you don't have to find a new investment every 5 years to invest in, redeploy, have that downtime, capitalism being put to work. But that's probably been unwritten pretty well to where it's earning a lot of cash flow or just it's a lot of upside to where it can be a great return over a long period of time. Normally it's not that way for a longer hold like that.
Yeah, exactly. I think if we break down which metric is most useful, it would be good for us to break down the investor archetype or investor profile for which metric is best. So I would say that income-focused investors, people that we see this all the time, people that are semi-retired and rely on their distributions as their income, should most likely be focused on cash-on-cash return. Who are the people that should focus more on IRR?
The ones that I think already have cash flow in their lives today. They already have great paying jobs. They already make money. We have a lot of investors like this today to where they're like, I don't care about the cash flow. All I care about, and some even have said like, keep the cash.
Yeah.
Like, I don't want to be taxed on it right now. But they care more about the upside, the equity and net worth increase.
So you in earlier episodes, you said that there are many ways to manipulate IRR. So if I'm looking at same timeline, same asset class, all this other stuff, but one has a 15% IRR and one has a 17% IRR, like why does context matter, and how can people manipulate IRR, and why should I pay attention to those, and how can I tell?
Yeah, and sometimes as a passive investor, you may not be able to tell unless you're really savvy and know what to look for. No, IRR can be manipulated or can be, it's an assumption, right? By many assumptions, such as hold period, so shorter hold period, higher IRR. Maybe you lower the exit cap rate, so a better valuation than maybe you should be on exit in 5 years. Maybe you have a higher rent growth projection throughout the years than is probably average or normal. Maybe you shrink your vacancy down to maybe only 3% when it should be 7%. All these little factors can all play a big role in manipulating the IRR, with the bigger one probably being rent growth and hold period.
Yeah, I think that's something that is important to mention from a previous episode is when we talked about returns. We talked about kind of like evaluating past performance of an operator and like what returns were there and what returns were projected. Projected versus realized returns. There is also such a thing as projected versus realized IRR. So looking at their exited portfolio versus their current portfolio and seeing where that is. Now you can't always rely on that, but similar to when we talked about, performance from a cash perspective, if their past 4 deals, had a projected IRR of 15% and they exited at 19+%, what that can not guarantee you, but almost assure you is that the projections are accurate and they're an effective operator to hit that 15. You're not guaranteed the 19. Don't rely on that. Don't invest because it's like, oh, I'll probably get 19%. There's a reason why they underwrote it at 15%, but that can give you the confidence as an investor to go into that and invest in that deal, knowing that that is a pretty accurate projection and they could even outperform.
Yeah, most times that'd be the case. I would say one caveat I'd throw in here in the mix, which is a little not quite on topic here, but would be the only caveat would be the people that had an upside in their returns that were realized compared to what they originally underwrote. When they went through a market cycle like we had a few years ago, they had compressing cap rates, decreasing interest rates. So you could see some operators actually had a neutral NOI over a 5-year period of time.
Yep.
So did they really operate the property better? Not sure, probably not. But that could be one thing that could throw off that exit realized IRR.
Yeah. So context matters.
Context matters.
Yeah. So it's something that context can be year cycles. Like, everything was selling for higher, post COVID, during COVID, et cetera. And so it's like,
So knowledge on the last 7 years is very helpful.
knowledge on the past 7 years is very helpful. Context within a portfolio is also helpful. With the restructuring in your operator, like you had mentioned, not so unseriously, but like what happens if an operator dies? Like, well, what is the succession plan? What does that look like? And then is it are past performances, if there's a downside performance, is that because, and have they replaced that person? Context matters. It's not just IRR versus IRR. Common mistakes that we see with investors abroad, this is a general thing, is chasing high IRR without understanding assumptions. Now, we talked about how IRR is based off of certain assumptions. One of the bigger ones is rent growth. What are the cautions that we talked about in our risk episode for people that didn't hear that one of what risks should we be aware of? Why is chasing high IRR without understanding assumptions kind of a dangerous strategy?
Yeah, I think you're just looking at one number on a deal or two deals that are always different. No deals are always alike, and no deals are always underwritten the exact same way. No deals are in the exact same location, same address. So they're all different. So you have to look at each deal differently, and trying to compare deal by deal just on a percentage rate of IRR without taking into account the deal or the risk level of the investment, I think it is not a very smart move for investors. For example, like let's say you have this actually happened last year. You have a development deal that's a 17% IRR projection, and you have a core plus deal and a 15% projection. Well, there's only 2 percentage points difference. And some investors may think, I want to get a 17 or 15. Well, do you understand the level of risk you're taking on, actual work it takes to actually get that development deal to perform at a 17% IRR compared to the core plus deal, already stabilizing, no big rent bump needed at all to get a 15? Well, do you want to sleep at night and be good with a 15 with a chance to outperform what the operator who's done well in the past, or roll the dice on a 17 and hope you get there and no cash flow for 3 years?
Yeah.
I mean, just common sense, right?
Yeah.
Those are two very stark examples, but that's pretty common though. And you'd be surprised that some investors, they look at that one number to judge a deal upon, and that is the wrong way.
Yeah, and we always say that you should be, as an investor, you should be compensated for your risk level.
Yes.
And that additional 2% increase does not.
It's the risk adjustment.
Yeah, the risk adjustment is too high. You are not getting enough. That 2% increase in compensation is not enough to adjust for increased amount of risk that you would have in a developmental deal, an opportunistic deal, versus a core plus deal of a newer vintage property of something that you say you don't have to raise rents, et cetera, et cetera.
Well, along the same vein, Jared, what would you say are, so an investor may ask, well, what are appropriate IRRs to look at for different asset types?
Yeah, I would say I'll start with core plus. That one, is pretty common. I would say anywhere from 13 to 14% IRR is a pretty industry standard. Now there are people that outperform that. We have outperformed on our deals. But if you're looking for, what is a good metric, I would say 13 to 14% is a healthy metric on a core plus deal. Value add and opportunistic / development deals will be higher because there's higher risk. What would you say that from a value add or an opportunistic deal would be an appropriate metric to kind of base it around?
Yeah, it used to be like 14 to 16 value add. That there's been more consideration for looking for higher returns just because of the level of risk involved. So I'd say mid to high teens IRR with value add deals is what we typically see out there.
Yeah.
Still, again, looking at the risk, look at the operator, look at the deal fundamentals. Those play a bigger factor to me than IRR. And development deals usually would be high teens and then maybe 20 or so, typically. And with the example I gave earlier, I would say a reasonable spread if operator did both deals together at the same time, I'd say compare a 15 versus a 23, 24. Like that'd be a pretty good spread to take on the risk for the development deal. So that's my thoughts.
I would also say that it's important to note that there are, especially within value add, there are different types of value add. It's like, is it a full demo reno? Or is it like, hey, we're going to do same day, renos in by unit. And so if so, your IRR there, that IRR range can overlap with the high range of a core plus deal. Yeah. So when I say 13 to 14%, or, you can have 14 to 16% in value add. So you could have a deal that is, or be evaluating deals that, hey, this is a 14% IRR core plus deal, and this is a 14% IRR value add deal. And those are both appropriate for the type of deal that they are. Yeah. Same thing with value add to opportunistic / development. How far is this development? Is this an assumed development? Is this something that got stalled because of, the previous developer wasn't able to finish the project and you assumed it? So you're not, you're not having to level, there's already permitting in place. You know what I mean? You should be compensated on your risk. And so there is the chance where it is appropriately overlapped the high end of value add and the low end of developmental. I think we've seen those too. And so there is a world where it is appropriate to one-to-one compare IRR with different type of deal strategies, but it's not as common.
Yeah, I think one more metric to look at too is like you could look at the location or the market the asset's actually in, because you take an asset in a tertiary market in the same construction build type year build in Phoenix, Arizona, well, you probably should be compensated for a higher level of risk, a higher IRR in the tertiary market that the deal is in, right? Versus Phoenix. Just a random example there. But so both carry different levels of risk. You've got a booming city, growing market that's more likely to be sustainable long term, whereas tertiary market could have more challenges along the way. So therefore, maybe a little bit higher R in those markets.
Yeah. So don't chase higher IRR without understanding the assumptions. Assumptions being market risk, assumptions being rent growth, all of those things. And so there is a little bit of education that's needed to be able to fully understand whether it's a good or bad IRR. But also, don't compare IRR to IRR and don't fully rely on that, especially based off your personal goals. If you are an income-focused investor, that metric should have less of a weight on what you invest in versus the cash-on-cash income for those focused investors. I think the best investors don't ask which metric is better. So, our title is kind of a misnomer. I think the best metric, or the best investors ask which metric matters for this deal and at this point in my life. Because I know investors that have been investing for 10 plus years that at the beginning, they needed the cash on cash. And so that was their income and that's what they wanted to do. And so that cash on cash is more important to them. They might be investing in properties. They might be investing in a debt fund because they want that higher piece. And then later on in life, they're like, I don't need the cash. I am living off of my retirement. I sold the business, what have you. And so they have the growth mindset, the capital the capital event-driven deal mindset, which is closer to an IRR being the more prioritized metric.
Yeah, I could agree with that. I think one more thing too would be maybe consider looking at those deals like what influence or what is sensitive to the IRR in terms of an exit cap rate or an exit or a hold period.
Yeah.
Like how sensitive is that IRR? For example, I saw a development deal last year to where if they missed the timeline to sell a development deal by just 6 months, it dropped the IRR from 20% to 10%.
Yep.
That's a pretty big number, and it's not uncommon in development to have things do a lower than expected. So I'd say look at what can influence the IRR to change. How sensitive is that number to the IRR changing so much?
Yeah. Well, this is our last Friday in February. Any special plans for March?
Hopefully getting warm outside. Maybe now I'm actually going to Montana for a retreat actually.
Oh, lovely.
Next weekend.
March has the first day of spring. The first day of spring is the 20th of March. Fun fact for you. So hopefully.
How do you know that?
It's my birthday. But yes, every year the 20th of March is the first day of spring. So there's that little pop there for you. My birthday does not fall on a Friday this year, unfortunately. So we won't be able to celebrate on the podcast. But anything else that you'd like to add to either close this episode out or close this month out?
No, this is great, Jared. Good job.
Perfect. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.